Julia, good morning, by the way. Earliest timing for a Fed pivot, Q4 2023, next year. So we're 12 months away. How do markets look between now and then?
So we think that we are going to stay in an inflation trading regime for the next couple of months because the momentum in inflation is still quite high. Even if you just look at shelter inflation, it's come down some of the leading indicators, but for the PCE, core PCE to show that takes at least a couple of months. And then you'll start to see maybe the employment market starting to show some weakness. We think that will be probably around mid of next year. But for us to get to a point where the labor market conditions are more fundamentally consistent with the Fed's inflation target, we think will take us to probably end of next year. So that's why we expect a pivot really only in Q4 of 2023.
Now, that GDP read we got, what did you make of it? What do you think the Federal Reserve is going to make of it? Because it was essentially the growth coming from net exports and more specifically increased energy exports as well, and there's much weaker imports too.
Yeah, so I guess there's, the strong dollar coming into play with that a little bit. But I think, the point I think here is that the weakness in the economy isn't really as big or coming as fast as people have expected. I think a lot of indicators on the consumer side actually are still pretty resilient. The housing market slowing at the margin, but under supply is actually pretty big.
But then you look at Amazon and Apple, and they're warning about what's going to happen in the fourth quarter.
Yeah, well, they're growth stories, right? They're growth narratives. But if you look at the underlying economy, it's really supported by ultra tight labor market. Unemployment rate is 3.5%. It's going to take, we think 12 months for that to really show a material slowdown that slows wage growth. So I think, the growth picture will start to weaken, but it's not really weakening as fast, and it's starting from a really, really, really strong position. So I think that, at some point next year, we think around mid next year, it will start to become a factor for the Fed. But I think until then, and even after that, inflation will continue to be a pretty important indicator for the Fed when they make policies. So we really have to come to a point where inflation is truly sustainably down, and we think that will be really end of next year.
Yeah, so it seems that the sort of sequence of events is the Fed hikes maybe until March and then keeps it there and we wait, and then we'll see when they start to signal that they're about to take rates low. Here's the question though, what do you do between say now and March, for example? Is it obviously not growth because you shot that down? Where do you want to be?
So we have been sort of hiding out a little bit in short dated, we call high quality credit. So these are select IG bonds that are really good companies, really good fundamentals. They're giving you 4 to 5% yield coupon right now to take on 2 to 3 year bond, let's say 2-year bond. So investors can take that and maybe ignore the mark to market, because by the time the bond matures, they're going to get 4 to 5%. And I think that that's a very important point at this point, at this juncture in the market, because cash rates are giving you 4% right now. Many investors are saying that's something I haven't seen in a long time on something that's risk-free. Right. So why don't I just do that, right? So I think that that's increasingly, I think, where we have rotated over the last couple of weeks as well. So I do think that we'll have to probably stay in these type of strategies until we see the regime shifting from inflation trading to maybe thinking about recession trading. And that's when you start to have greater opportunities in the broader set of fixed income, including long duration.